and I want to talk about a little trick you can use. I call it the candlestick count confluence method. Now, the candlestick count confluence method is a way to kind of add the probabilities in your favor of at least a pause or a reversal at a level. So what I mean by that is if we count candlesticks, so bullish and bearish, what you'll tend to have is maybe a couple of consecutive bullish or bearish candlesticks, 3 here, 2 there, 2 bullish, 3 bearish, 2 bullish, 3 bearish, 2 bullish. And even as you have this little downtrend here, you've got 1, 2, 3, 4, 5 consecutive bearish candles, and then you've got a bullish candle, and then you've got a few bearish candles, and vice versa coming up. So the candlestick count, as you see consecutive candles, is usually about 3, 4, possibly into the 5s. It's very rare that you get it gets rarer as you go to 6, 7, 8 consecutive bullish or bearish candles. As you can see, if we go back again, you can just do a count on your own chart as well and see how many bullish and bearish consecutive candles the average is. It's usually around about 3, 4, 5, possibly into the maybe 6s. Again, it gets less I suppose it's rarer as you get into the 6, 7, 8. So when you see consecutive candle counts into a level of maybe 7, 8, or 9, 10 plus into a major supply and demand or support and resistance level, that should give you some confluence of at least a pause or a reversal, right? So for example, we're on the pound dollar daily chart. So we've got a consecutive candle count into this level of supply of 1, 2, 3, 4, 5, 6, 7, 8 consecutive bullish candles. Now you have to expect there's going to be some pause. I mean, the probabilities are pretty much in your favor. If you think about the psychology, if you were a trader down here and you bought, where are you most likely to take profit? You're going to take profit up here. And if you buy down here, you're going to sell up here. If you're a supply and demand trader or support and resistance trader, where are you most likely to probably try and get short? It's going to be around here. So there's going to be a whole load of sell orders around. So again, once price reached up here, it's very rare that price will continue into the 10, 11, 12 and really kind of break through a level. So don't be scared when you see this type of price action. I know it's bullish and it looks like you're basically selling into a really strong momentum move, but you've got the candlestick count confluence probabilities in your favor. Don't be scared of something like this. In fact, I love looking for things like this because it gives me the confluence in my trades to know that I'm should be on the right side of the market if we do get a pause, especially if you're trading on the lower time frames. So there's definitely an opportunity to make some money on the lower time frames. Let me see if I can find another couple of examples on some other charts. So here's an example on the New Zealand yen pair from the downside and the upside on the weekly chart. So you can see there was some resistance here, resistance, which then turned to support. Now, as prices came down into this level, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 down weeks into this level of broken resistance, now turned support. So you can have some confidence that people who basically were selling up here are going to be taking profit down here. And again, the longer it carries on is the more you should see a pause or reversal. I'm not saying that you're going to definitely get a reversal here or anything like that. It's just because it also depends on fundamentals and sentiment and what's going on behind the scenes, central bank policy, etc., etc. So But I'm just saying that the odds are in your favor the longer you see the consecutive candle count. And now we have up to the upside, so we have this area of supply. So we have 1, 2, 3, 4, 5, 6, 7 weeks of of bullishness, and then we get our pause. So then what you would, you're more likely to do is look at this level on an intraday chart and then see if you can, see your entry and have that confluence behind you that you've had. You're going to have at least some supply up here again from traders taking profit from down here all the way up here. You've got supply and demand traders, supply traders, getting in here, support and resistance traders, etc., etc. So I hope that helps. Have a great trading week, and I suppose weekend. Now it's Friday, so I'll speak to you soon.
To has a double top. Now the first thing you want to make sure you have in conjunction with your double top is a strong up move and preferably a trend before the double top appears. While price was coveted at the start of the move, being very cheap, it's trended higher, buyers have made their profits, and it's starting to get to a point where it's too expensive to continue buying. So let's take a look at this chart as it brings up some issues that traders usually want clarification on. The typical question traders want to ask is price allowed to trade above the previous high in a double top? And the answer to that is yes. As long as price does not close above this previous high, your double top is still in effect. So what I would suggest you do is grab yourself an horizontal line and place it at the previous high before the retracement to basically check if price closed above this previous high. And this is actually quite an important rule, not only to tell you when your double top is invalidated, but also making sure you pick the right neckline for your double top pattern. And before we go into talking about the neckline, I'll quickly want to show you an example of price closing above the previous high, invalidating a double top. And we've got one right here on this chart. As previously said, it's okay for price to trade above this previous high as long as it doesn't close above it. And in this case, it does close above it. Therefore, the double top is invalidated. And what that does is shift the focus from this swing point, which now becomes a lower high, to the next swing point that's generated from this new high. Now, the neckline is basically the turning point in the market before the failed attempt of the market breaking past the previous high. This is important to traders as some people use it as part of their entry strategies. Now, there are different types of entries when it comes to trading the double top. Some people enter at the sign of a truly bearish candle after the market shows signs of topping out, which is a very aggressive entry. And some traders wait for the market to break past the neckline, closing below it before jumping in the market. And others basically wait for a pullback and retest of the neckline before taking the trade. Each entry has its advantage and disadvantages. The longer you wait to get a clear confirmation of the double top reversal happening, the more pip risk you would have to take. So for instance, if you should enter on the retest of the neckline, which is a safer option to take, you'd have to keep in mind that the safest point for your stop loss still remains above the highs created way up here. However, if you jump into the trade too early, oftentimes you see the market stop you out before confirming the double top. The choice is entirely up to you as a trader on what to do. If you're more inclined to be aggressive, you might not mind speculating a short at these locations, or you could wait for the break of the neckline with more pip risk, and the safest possible entry would be a retest confirmation with even more pip risk. Now let's take a look at the inverse setup, also known as a double bottom. And I know at this point everyone's eyes is fixed to the bottom of this chart as a perfect example for a double bottom. However, this gives me an opportunity to show the importance of price closing above previous highs and selecting the right neckline can be so important in making a good trading decision. If I just zoom out of this chart and we apply the rules we've discussed, we start to see that this in fact is not the neckline of this double bottom. It's actually way up here. Now going back to the past, we can see how price made a significant move down while trending, putting in a low that was never broken in the sense that price never closed below this low. If we should put our horizontal line on the chart, we see that price never closed below this low at any point, keeping this the turning point of the market before the overall failure to break to new lows. This highlights the importance of zooming out, looking to your left, and really analyzing your chart before making your decisions. Our neckline entry point begins only after price breaks and close past the neckline at this location, or after trading away, pulling back, and then giving us bullish confirmation. This particular setup also highlights the reason why placing your stop loss below the lows of the double bottom is still the safest area for your stop loss. And yeah, that's it from me. I hope you enjoyed.